What if I told you that the vast majority of the money circulating in our economy doesn't actually exist as physical currency? It's not stored in towering vaults, waiting patiently for someone to withdraw it. Instead, it materializes out of thin air the exact moment a bank approves a loan. This isn't a hidden conspiracy or a financial loophole. It is the foundational operating system of modern commerce, a mechanism so deeply embedded in our daily lives that you interact with it every single time you use a credit card, sign a mortgage, or check your checking account balance. The system has a formal name, fractional reserve banking. And while it sounds like complex banking jargon, it's actually the invisible engine that quietly expands and contracts the entire economy. Today, we're going to pull back the curtain on this financial machinery. We'll walk through exactly how commercial banks multiply purchasing power from nothing, why governments and central banks rely on this model, and what it truly means for your savings, your debt, and the price of everything you buy. By the end of this video, you'll understand one of the most powerful economic concepts ever devised, explained in straightforward, jargon-free terms. Welcome to the channel. If you've ever looked at a bank's balance sheet and wondered how an institution can lend out billions of dollars while only holding a fraction of the amount in actual customer deposits, you're asking the right question. The modern monetary system operates on confidence, accounting rules, and a carefully calibrated level of leverage. Fractional reserve banking is the practice where commercial banks are legally permitted to keep only a small percentage of their depositors' funds on hand as reserves, while deploying the remainder into loans and investments. But here's the crucial part that most people miss. When a bank makes a loan, it doesn't just shuffle existing money from one account to another. It creates new money. That newly created money flows into the economy, gets spent, gets deposited elsewhere, and triggers another round of lending. This continuous cycle is what economists refer to as the money multiplier effect. Over the next 15 minutes, we will break down the mechanics, trace the historical evolution, examine the real-world consequences, and separate fact from fiction regarding how modern money is born. Grab a notebook because this is financial literacy that actually matters. Let's strip away the complexity and look at the exact sequence of events when money is created. Suppose you deposit $1,000 in cash at your local commercial bank. The bank records this as a liability on its books because it owes the money back to you on demand. Simultaneously, it gains an asset in the form of physical cash. Under a standard fractional reserve framework, the regulatory authority might mandate that the bank maintain a reserve ratio of 10%. This means the bank must set aside $100 in highly liquid form, either in its vault or as a balance at the central bank. The remaining $900 is now free to be deployed. When you apply for a personal loan and the bank approves it for $900, they do not hand you a stack of bills from your original deposit. Instead, they simply credit your loan account with $900 in digital form. In accounting terms, they create a new deposit liability and a corresponding loan asset at the exact same moment. New money has just entered the financial system. You then use those funds to purchase a laptop. The retailer deposits the $900 into their own bank account. That second bank now faces the same reserve requirement. It keeps $90 in reserve and lends out $810 to another borrower. That borrower spends it, the rest of it deposits it, and the cycle continues. Each iteration creates additional purchasing power without a single new physical bill being printed. The initial cash deposit acts as a seed, and the banking system acts as the soil, water, and sunlight that allow it to grow into a much larger economic tree. This repetitive lending and depositing process is formally known as the money multiplier, and it's the mathematical backbone of fractional reserve banking. If the required reserve ratio sits at 10%, the theoretical maximum multiplier is exactly 10. In simple terms, an initial reserve of $1,000 could eventually support up to $10,000 in total money supply across the entire banking network. However, the real-world multiplier is consistently lower than the theoretical maximum. Why? Because human behavior and institutional risk management introduce friction into the system. Banks rarely lend out every single available dollar. They maintain excess reserves to cover unexpected withdrawals, comply with stricter internal risk models, and prepare for economic downturns. Borrowers don't instantly spend every cent they receive, and many people choose to hold a portion of their wealth as physical cash or in non-deposit accounts. Furthermore, loan repayments actively destroy money. You pay down your principal balance, that digital deposit vanishes from the system, reversing the creation process. Still, the core principle remains unchanged. Commercial banks function as money creators, not mere storage facilities. Your debt becomes the economy's new purchasing power. This dynamic is why central banks monitor credit growth so closely. If lending expands too rapidly, inflation can spike. If lending contracts too sharply, recessions can follow. The multiplier is not a magic trick. It is a calibrated economic lever To truly understand why fractional reserve banking exists, we have to travel back several centuries to the bustling trade hubs of medieval Europe. Long before modern central banks or digital ledgers, merchants relied on goldsmiths to safeguard their precious metals. Carrying heavy coins across treacherous roads was dangerous and inefficient, so depositing gold with a trusted craftsman became the norm. Goldsmiths issued handwritten receipts as proof of ownership, and soon merchants realized they could simply transfer these receipts to settle debts instead of physically moving the metal. A brilliant but fragile realization followed. Not all depositors would demand their gold back at the same time. Recognizing this pattern, enterprising goldsmiths began issuing more receipts than they held in physical gold, effectively lending out promises backed by a fraction of the actual reserves. This practice supercharged trade and commerce, allowing economies to grow far beyond the constraints of their physical gold supply. Yet it carried an inherent vulnerability. When confidence faltered, usually during political unrest or market panic, depositors would rush to reclaim their metal simultaneously. These historical bank runs frequently bankrupted early lenders and disrupted regional economies. Over centuries, societies learned to mitigate these risks through centralized oversight, standardized reserve practices, and eventually, government-backed deposit insurance. What began as an informal merchant convenience evolved into a highly regulated financial architecture designed to balance economic expansion with. Understanding how money is created is only half the story. The other half is recognizing how this system shapes everyday life and macroeconomic trends. Fractional reserve banking is fundamentally a growth accelerator. By transforming idle savings into active credit, it enables families to purchase homes, entrepreneurs to launch ventures, and governments to fund infrastructure without requiring upfront cash. This liquidity is the lifeblood of modern capitalism. However, the same mechanism that fuels prosperity can also amplify financial instability. When credit standards loosen and optimism runs high, banks extend loans to riskier borrowers, driving up asset prices and inflating economic bubbles. The 2008 global financial crisis serves as a stark illustration of this dynamic. Financial institutions packaged subprime mortgages into complex derivatives, assuming housing values would continue rising indefinitely. They effectively multiplied money against increasingly fragile collateral. When the housing market corrected and defaults surged, the digital money that had been created began to evaporate. Borrowers stopped repaying, lenders stopped lending, and the money multiplier reversed direction violently. The resulting credit freeze triggered a worldwide recession, massive job losses, and unprecedented government intervention. Recognizing these cycles helps everyday citizens make smarter financial decisions. It explains why interest rates rise and fall, why housing markets fluctuate, and why economic downturns often feel sudden despite months of warning signs in credit data. Given the inherent leverage in fractional reserve banking, you might reasonably ask why the entire system doesn't collapse under its own weight. The answer lies in a sophisticated, multi-tiered regulatory framework designed to absorb shocks and maintain public trust. First and foremost, central banks serve as lenders of last resort. And commercial banks face temporary liquidity shortages but remain fundamentally solvent. The central bank provides emergency funding to prevent a panic from spiraling into a systemic crisis. Second, governments establish deposit insurance programs to eliminate the primary trigger of historical bank runs. In the United States, the Federal Deposit Insurance Corporation guarantees deposits up to a specific threshold per account holder, assuring the public that their savings are protected even if a financial institution fails. Third, modern banking regulations extend far beyond simple reserve ratios. Institutions must meet stringent capital adequacy standards, maintain liquidity coverage ratios, and pass regular stress tests that simulate severe economic downturns. These rules force banks to hold high-quality assets that can be quickly converted to cash during emergencies. Additionally, monetary policy tools like open market operations, reserve requirement adjustments, and forward guidance allow central banks to influence lending behavior proactively. While no system is entirely risk-free, these safeguards transform fractional reserve banking from a fragile experiment into a remarkably resilient engine for global commerce. Despite its widespread adoption and regulatory oversight, fractional reserve banking remains one of the most misunderstood concepts in personal finance. One persistent myth claims that banks physically print currency when issuing loans. In reality, they create digital bank deposits, which represent broad money, rather than physical legal tender. Another common misconception is that the system is inherently deceptive or illegal because money originates from accounting entries rather than tangible assets. Economists, legal scholars, and financial regulators universally recognize it as a legitimate form of financial intermediation, operating within established contract law and monetary policy frameworks. Some critics argue that eliminating fractional reserve banking would erase personal and national debt. While it would certainly alter how credit is issued, it would also drastically reduce the availability of capital, likely stifling economic growth and pushing lending into unregulated shadow banking sectors. Finally, many people confuse reserve requirements with capital requirements. Reserves refer to liquid funds held at the central bank to meet daily withdrawal demands, while capital represents the bank's own equity, acting as a financial cushion against loan defaults. Both metrics are critical for stability, but they measure entirely different risks. Separating fact from fiction is essential for developing a realistic understanding of how modern economies actually function. Fractional reserve banking is neither a magic trick nor a financial conspiracy. It is a carefully constructed economic infrastructure that converts dormant savings into productive capital, leveraging trust, accounting principles, and regulatory oversight to keep markets moving. Every time you deposit a paycheck, finance a vehicle, or observe central bank interest rate decisions on the news, you are engaging with a system that has driven global prosperity for generations. It is remarkably powerful, inherently cyclical, and demands continuous oversight from policymakers, financial institutions, and informed citizens. The next time you review your loan statement or check your account balance, remember that you are not merely moving money around. You are participating in one of humanity's most sophisticated economic innovations. Currency isn't just stored. It is created, circulated, expanded, and retired through a continuous cycle of credit, repayment, and confidence. Understanding this cycle empowers you to navigate interest rate changes, evaluate borrowing decisions, and recognize the broader economic forces shaping your financial future. If this deep dive helped you finally understand how money is actually created behind the scenes, please hit that like button. It genuinely supports the channel and helps these educational videos reach more viewers who want to build real financial literacy. Make sure to subscribe and enable notifications so you never miss a breakdown of economics, personal finance, and wealth building strategies. Now I want to hear your perspective. Do you view fractional reserve banking as an essential tool for economic growth, or do you believe we need to transition toward a completely different monetary model? Share your thoughts in the comments below, and I will be reading and replying to as many responses as possible. Thank you for investing your time in learning today, and I will see you in the next video.